would like to welcome everybody to the webinar this morning, which is part 2 of our very informative cryptocurrencies webinar. So I'd just like to say, if you haven't looked at the first webinar, please do so. And at the end of the webinar today, we will actually circulate both sessions for people to backfill their information to start with, to get the grounding as to what cryptocurrencies are. And today we're going to focus on, looking at Bitcoin versus other options. We're going to talk about risks, and we're also going to talk about how to invest and what makes sense in terms of investing. And so today we're going to get into a whole lot more information after setting the groundwork in our last webinar. So I'd like to welcome everybody here, and I'd like to say thank you very much to Tim, Max and Mike for joining us from Mason Stevens. You guys have just a fantastic resource and information that we draw on regularly, and we thank you for sharing your insights on cryptocurrency with us. And so I'll hand over to Tim Yule, who's the Managing Director at Mason Stevens, to get going this morning.
Thanks, Carolyn. And it's a joy to be out of the rain. Down in Sydney, we've had incredible amounts of weather, so a little bit jealous of most of Brisbane and broader Queensland, which have had a much better take on things in terms of the weather than we had the last couple of days. Look, I'll keep my comments very brief in terms of where we're going today. I think the most important thing to think about is digital currency is probably one of the most talked about and hyped asset classes that there is on planet Earth. And if you've got a few grey hairs like I have, you would have seen this play out in a number of asset classes and fields over the last 25 odd years, and you can go back literally hundreds of years to get a similar sort of thing in terms of the hype that is surrounding cryptocurrency and blockchain. I think there are obviously massive bulls and massive bears, and the regulators are probably somewhere in between. And we've seen Powell come out, the Fed Reserve chair, I think, come out last night with some comments around cryptocurrency, basically saying it is a speculative investment at present, and it is not a store of value because of the volatility inherent in a lot of these currencies. And the boys will talk to some of the implications about things like regulation today and what that means for the future prospects for digital currencies. But more broadly, what we wanted to focus on is, well, what actually is a digital currency? How does it differ from what else is out there in terms of real money? And then how are different currencies differentiating themselves in terms of the crypto universe? So it's a fascinating area. As Carolyn said, if you haven't had a look at the blockchain webinar, please look at that, because that's a wonderful primer as to the underlying technology that's driving it. Crypto and digital currency is really the end product of that underlying technology. So spend 20 minutes going through that and then jump back into this. So without further ado, hand over to you, Max, and you can take us forward.
Thank you, and thank you for having us back. So as Tim said, we discussed blockchain last week. Today, we're going to have a touch on, more specifically, cryptocurrency. For the purpose of this talk and for the purpose of them being most popular, we'll mostly touch on Ethereum and Bitcoin. But we'll talk about the infrastructure more generally as well. So we touched on the current use cases of cryptos last week, being a medium of exchange, partially proven, but plenty of runway to go. Store of value, despite what Fed Chair Powell says, it is the most championed narrative at the moment. And then in cryptos like Ethereum, you also have a platform of smart contracts. So we know what they can be used for, but how exactly are they different from each other? Because obviously, if all cryptos are the same, we'd all be buying Bitcoin, but there are plenty of people out there buying the alts. So cryptos differ on several features, mostly associated with how they interact with and operate on the blockchain, including how end users can access them, utilize them, and put them into practice. So they differ on the basis mostly of their consensus mechanisms, supply mechanisms, and the concept for which they outline their purpose as a coin. So to talk about mechanisms quite quickly, these are the methods in which the miners, aka the nodes along the blockchain, can validate any one transaction being made by a coin. There's two main mechanisms which are employed at the moment. Those being proof of work, which is mostly employed by Bitcoin, and proof of stake, which is employed by Ethereum. So proof of work basically involves miners solving complex algorithms. Mike's actually described it a bit like a 1,000-piece puzzle every 10 seconds or so, completely randomized, in order to gain the right to validate that transaction. So basically it's saying, you know, if this transaction exists, work has been done to validate it, therefore we will let it go through because it is a real transaction. Now, it uses some pretty heavy computational power to actually achieve these goals. And the more miners there are on the chain, the heavier the transaction proof of load will occur. Oh, my apologies, I didn't realize I hadn't shared slides. Proof of stake, on the other hand, is basically miners showing that they do indeed hold the coins. So any user, for example, of Ethereum, any user with at least 32 Ethereum is able to stake these tokens and act as a miner. So you might be a very small piece of the puzzle, but at least you can say, I have proven that I own these coins, therefore the transaction should be valid. Now, this uses less computational power because it's on the basis of holdings. However, we'll discuss there's some challenges associated with that as well. Look, each has its advantages and disadvantages, and those will intrinsically relate back to what you think the end value of the coin should be. So proof of work, very highly energy intensive, requires an enormous amount of computational power, particularly as the blockchain grows. There really is no, at least immediate term case where the power needed to solve these transactions looks like it's going down. If anything, it will exponentially increase as more miners are added to the blockchain, as more value goes into Bitcoin as a coin. So that's a sort of very present and future risk. Proof of stake has faster transaction speeds, less energy consumption, less hardware. However, it is more centralized. So in the case of proof of stake, you have the advantage more or less if you are the wealthiest in the blockchain. So the more Ethereum you have, the more power you have over it. So in that sense, it could be argued that it's slightly less meritocratic. On the other hand, of course, proof of work, you still need the capital to be able to solve these things, but it is still less, I suppose, based on how much individual wealth you have as proof of stake. They can also, cryptos can also vary on the basis of their supply mechanisms. So Bitcoin has a finite supply capped at 21 million coins. Litecoin has about 84 million cap, whereas other coins will have an unlimited market supply, and it's more based, much like fiat currency is now, on supply and demand mechanisms within the market to regulate it, as opposed to it's capped at this and it's always ever going to be. Now, having a finite supply doesn't necessarily mean that there is store of value characteristics inherent in the coin. Ethereum has no cap on supply, but there is also the benefit to that of there's no capped reward to the miner as supply becomes tapped out. So with Bitcoin, a legitimate theory is once all 21 million Bitcoin have been mined out, supposedly around 2140s, we touched on it last week, there'll be more and more reduced rewards to the actual Bitcoin miners because suddenly they can't be paid from new Bitcoin issuances. It has to be pulled out of the existing market. So that's another sort of distinguishing factor between the two. And of course, they also vary by the desired purposes. So some may want to be a medium exchange, and in that case, between the two that we talk about here, Ethereum is certainly better placed. Or as platforms for the creation of other services. So again, Ethereum is better placed for a smart contract. However, it's a store of value as something more of a speculative, almost gold-like asset, then Bitcoin at the moment is the market leader there.
So I think just to jump in there, one of the most important things to recognise about this universe is that there are very, very different models of how these digital currencies are operating, if I'm understanding correctly, which means you are not just taking a view on digital currency, you're taking a view on a particular value creation, value store, and information transmission, as opposed to just investing in, well, they're all the same. So if I can't get access to Ethereum, I'll just try Bitcoin.
Correct.
That's a really important point that's worth thinking about. If you are thinking about investing in this, understand exactly what you're investing in, why you're investing in, and what's the future going to look like for these. Because I suspect not all of these currencies are going to be around in the next 5, 10, 15 years as technology emerges, evolves, change. I suspect there will be very clear winners and there'll be some spectacular losers as well. So, you know, the classic investment thesis is diversify, 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 but also have a good understanding of what you're doing and why when you're coming to investing. So,
on what Tim said, it's analogous to if in the 80s you had either decided to buy a basket of IT security, so you might have bought Microsoft, Apple, Linux wasn't a listed security, but several of them, or you might have just gone for one. You might have banked on Steve Jobs, or you might have banked on Bill Gates. It's analogous to that in if you're taking a stance on one particular coin at the moment, you are not just backing the coin itself or its brand power, you are backing the tech. And much like in the 80s, there was no real way to predict, unless you sort of believed wholeheartedly in the vision, that any one of those companies would become the global titans that they are now. Yeah.
Great, thanks for that, Max. Now, we touched briefly on Bitcoin and Ethereum last week when we were discussing current use cases of blockchain technology. But given they are the two largest cryptocurrencies by market capitalization, making up 72% of the market, we'll focus on them in a bit more detail. So firstly, Bitcoin makes up 60% of the total market capitalization of cryptocurrencies. As we discussed last week, as Max has also mentioned, it's taken on the mantle of being a digital gold in the past year. This has come in the midst of unprecedented fiscal and monetary stimulus in response to the COVID-19 pandemic, which has driven investors into inflation-hedged assets. Now, Bitcoin, as Max has mentioned, is able to act as an inflation hedge given its fixed supply of 21 million coins. However, it was originally intended to be a medium of exchange, and investors have sort of overlooked this element of Bitcoin and have overlooked the issues which it carries in its relatively unscalable current state. So right now, Bitcoin can only process 7 transactions per second. And when compared to Visa, which can process 65,000 transactions per second, it stands to be quite an issue if Bitcoin is to be a global medium of exchange. The issues as to why Bitcoin can only process 7 transactions per second lie in its original operating protocol. In this protocol, it states that block sizes can be a maximum of 1 megabyte, and one block can only be created every 10 minutes. Now, within these blocks, you can only fit roughly 4,200 transactions. It is also noteworthy that the size of the Bitcoin transaction will not influence the amount of memory it would take up within this block. So this block could be made up of 4,200 transactions for a $4 cup of coffee, or it could be made up of 4,200 transactions of $1 million settlements for properties, and it would be the same size. So as you can see, it would be an issue if everyone decided to go and buy their morning cup of coffee with Bitcoin, because the transactions would take days, if not weeks, to be processed. However, the Lightning Network is set to be rolled out through Bitcoin on major exchanges this year, which will go some way to alleviate these scalability concerns. So the Lightning Network is a layer 2 protocol, which means it exists above the Bitcoin blockchain. So it exists sort of on a level above it, acting as a secondary payment channel. So the Lightning Network, as I said, it's a secondary payment channel which enables individuals to transact in Bitcoin off the main blockchain. An example of how we could use a Lightning Network would be through a coffee shop. So a coffee shop would open up a Lightning Network in which it can transact with its customers. The customers would deposit a certain amount, let's say 0.005 Bitcoin. The customer would then buy coffee from the cafe. And in that process, they would pay 0.0001 Bitcoin. This would then be reflected in the outstanding balances for the two. So the cafe would now have 0.0001 Bitcoin, and the customer would have that amount deducted off their balance. This can occur hundreds or even thousands of times until a point where the coffee shop owner decides to close the channel, at which point the total amalgamation of all the transactions is submitted to the blockchain in the form of one transaction. So what we could see here is having all this activity off the main blockchain and then just added back in as one transaction, saving a lot of time and money and alleviating the concerns regarding Bitcoin scalability.
So is that like doing your banking at the end of the day? So
Yeah.
if you're, when the blue line here, the two arrows on the right-hand side,
Yeah.
transacting, coffees are being bought all day, and then the coffee shop closes their shop.
Yeah.
They go to the bank, which is actually a digital bank on the blockchain, and settle their transactions.
Yeah, correct.
Cool.
Yeah. So this would eventuate, if this is rolled out worldwide, what would happen is the main Bitcoin blockchain would be used for settling these Lightning networks on an occasional basis, and also only for one-off transactions between parties. So the majority of repetitive small transactions could occur in these off-chain Lightning networks. So now that we've looked at Bitcoin, let's look at Ethereum. So Ethereum leverages the blockchain in a completely different way. It acts as a platform for the creation of decentralized apps, also known as dApps, through using smart contract technology. So as we mentioned last week, these decentralized apps can carry a multitude of purposes, providing legal contracts, security settlements, identity verification, healthcare records, and much more. Put simply, if we are to see Bitcoin as a digital gold, then we can see Ethereum as, say, the internet. Previously, to create blockchain applications, developers were required to have expertise in cryptography, coding, and mathematics, and would also have to exert significant time and require significant resources. Through Ethereum, developers are provided with the tools to create these decentralized apps, saving them a lot of time and resources and making the creation of decentralized applications more accessible. All decentralized apps on the Ethereum network are powered by Ethereum tokens, which is where the value of these tokens come from. The more people that are using these applications, the more value these tokens will have. As mentioned before, Ethereum doesn't necessarily have a supply cap, given there will have to be a considerable amount of Ethereum tokens flowing around to keep these decentralized apps going. However, there is a supply cap of 18 million new coins per year. As Max mentioned, it runs on a proof-of-stake consensus mechanism where anyone with 32 tokens can act as a validator of transactions. These 32 coins are staked to the network, but this doesn't necessarily guarantee that you can be a miner. You still have to act in the best interests of the network, and you are punished or rewarded accordingly. This leads to a more energy efficient network, but obviously it leads to issues where there could be a centralization of the mining, where only the richest can perform transaction validations. So now back over to Max to talk about the risks of cryptocurrencies.
Thanks, Mike. So I'll step in and be the cynic again and just discuss what pitfalls we may find with cryptos, and obviously there are a lot. But really, I think it's best to touch on some specific ones that aren't necessarily just mentioned, volatility, things like that. So first, and probably the most applicable to every asset class, is human error. So much like any banking transaction, there can be a stuff up in a cryptocurrency transaction. However, it becomes much more difficult because the blockchain is immutable, and there's no central authority to sort of manage that kind of error. So without, for example, a bank acting as our custodian, if we were trading money between each other, you accidentally send it to the wrong BSB, you accidentally send the wrong amount, there's only basically between, if I send the wrong amount to Mike, this is between Mike and I a negotiation there, and he's within his right to go, you've paid me double, I have no reason to pay it back. So that's sort of a risk that comes with not having a central authority. And it takes up issues with crypto being a medium of exchange. People will require a significant amount of education on how to actually go through this process, what the risks are, what is an appropriate means of conduct to transfer, and much like with any new technology, having an embrace of it, not just from a rote learning level, but from actually understanding what's going on and understanding the risks of it, is one of the main challenges that sort of faces any kind of tech frontier. So that's something that we might see in the future. Now, there is the risk of malicious attacks. As Mike touched on last week, blockchains are incredibly hard to hack. The power to mine cryptocurrency, which I called before hashing power, is spread across many, many parties, and that's designed to take away some of the risk. But a common question to ask is, what happens if someone has 51% power? So in the case of Bitcoin, which is probably the most difficult, what if someone has 51% of all the computational power on the network? They could hypothetically reverse transactions which are in place at the moment, block transactions, potentially reverse the orders on the previous block of what transactions took place. And for Ethereum, it would be the case of if someone owns 51% of all the Ethereum in the world, they could then go through and do something similar. Now, probably the counterpoint to this is, if they really did have that level of computational power or wealth, for one, it's a massive capital expenditure to either buy that much Ethereum or have that many computers. And realistically, the gain is pretty marginal for two reasons. One, you can realistically, in the case of Bitcoin as an example, only change what happened in the last 10 minutes because a new block can only be created every 10 minutes. So in the scheme of things, how much it would take to actually get that level of power, it's probably not worth it for whatever kind of malicious gain someone could get. And on the other hand, after that first 10 minutes, once sort of the general public sees that something has been altered like that, and the blockchain is transparent for this reason, the share value, the coin value would absolutely plummet, because people have suddenly lost confidence, particularly in a speculative asset like this. If you have no confidence in the security, there is no value in the security. So it's almost a self-muting point that yes, if someone had that level of capability, they could hack it. At the same time, they would get maybe 10 minutes of benefit, and it would be very marginal compared to what they'd have to outlay. So for the moment, at least, that 51% attack risk looks pretty immutable. Energy is another risk we touched on throughout this call and last week, particularly proof of work. Will there be enough energy to process, for one, the level of mining required to get that extra 20 million coins or so that are still not mined? But also, if amongst the Lightning Network, amongst the blockchain, if transaction volume ramps up for Bitcoin, and we need multiples, 10 times, 100 times more miners and therefore computational power to actually handle these transactions, is there enough free energy in the world at the moment to actually handle it, let alone building computers, building the infrastructure to be able to process that? So that's another risk going forward, particularly for use as a medium of exchange. Finally, decentralized assets. There's no specific government or institution that's part of the narrative. It's power to the people, but at the same time, governments and institutions are generally there for a reason. So if there is no central body regulating it, who makes the rules? Why do they get to make the rules? Is it, it's a very laissez-faire way to approach it, but at the same time, without regulation, there is no framework to how this should operate besides what's built into the coin or a smart contract. So governments are still trying to figure out, if we can't regulate it, then who is? Kentucky's just put through legislation to incentivize Bitcoin mining. In other words, if we have all the mining here, then they pay, the actual physical companies pay the tax to us, and then we can put pressure on them to sort of work the way that we want to. On the other hand, you have China and Russia, I believe India as well, who've come out and basically banned Bitcoin mining in certain areas to do the complete opposite. If we can't do it, neither are you. So that's a sort of ongoing geopolitical issue. And much like with any global asset class, that's always something that investors have to take into account. For example, we still can't escape sovereignty risk. America has 5% of all Bitcoin mining, whereas China has 60%. So you think that you're escaping from, you know, overall sovereign rule, but the chances are if China manages to get 90%, 80%, basically controlling stake in Bitcoin mining, then not only do they get the revenue from it, which of course is important to the global economy, but they also can start to put pressure on, well, we actually think that Bitcoin mining should be done like this. And if 80% of the blockchain is validated by you, then you have significant room to strong arm people. The last point that I want to make before we move on to investments, and this relates to actually buying the coins themselves, be it directly through an ETF or through a fund like we'll talk about, is people don't necessarily think about the downside volatility of this asset class from a portfolio construction point of view. You know, there's blue sky forever, but how much can I lose? The point is that at the moment, there are virtually no ways to protect against a downside shock, you know, the asset pulling back 50% a day, which, while unlikely, is entirely possible. We might have said 2 years ago that it's unlikely that it'd be breaking 60,000, but here we are. We might very well see 100,000 by the end of the year. You know, even to institutional level investors, there aren't what's called long-short funds, where you can actually take a position thinking that Bitcoin might go down. On a sort of overall basis, there are options popping up out there. So, in other words, you're either long or you're out. There is no option in between. And on that, Mike is going to talk us through some of the investment options.
And I might just jump in here, as Carolyn said before, last week when we were talking about investments, these are not recommendations at all. So we don't want people jumping out and going and buying everything that we put on the screen. These are just some examples of ways in which more mainstream investment markets are starting to provide access to different investments in this space. So please just bear that in mind as we go through this, this next section.
Great. Thanks, Tim. So there are a number of vehicles which can be used to give direct exposure to cryptocurrencies in financial markets. So the first option is through a listed trust. Now, given the lack of approval of the respective securities commissions to operate under ETF structures, passive crypto funds have had to operate under listed trust structures. The most popular of these is the Grayscale Bitcoin Trust, which has approximately 38 billion US assets under management. It's structured where only accredited investors can purchase shares linked to the underlying Bitcoin. These private placements occur on a daily basis, and these accredited investors have a lockup period of 6 months. So as a result, premiums and discounts to NAV exist when there are imbalances in supply and demand. As you can see on the chart on the screen, the premium went up to 40% in December 2020. So this listed trust structure in the long run was relatively unsustainable. However, with the approval of Bitcoin ETFs, there's been a collapse in this premium, as you can see at the end of the chart. So crypto ETFs offer a more accessible and efficient manner to gain exposure to cryptocurrencies, with premiums to NAV typically being corrected quicker than listed trusts, given the creation redemption process. As you can see on the chart, the ETF provider is able to more readily provide securitization of the underlying asset, as opposed to a listed trust structure where you might have to wait up to 6 months to be able to get that supply into the secondary market. For cryptocurrencies, ETFs have been faced with regulatory hurdles for years, given the questionable position of cryptocurrencies as an asset class. However, the approval of a Bitcoin ETF by the Ontario Securities Commission recently this year was a milestone for North American investors, providing exposure to those investors who weren't willing to self-custody cryptocurrencies, and those investors who weren't willing to invest into a trust structure. The Ontario Securities Commission has since approved a second Bitcoin ETF, with 2 Ethereum ETF applications in place. As you can see on the screen, the 2 listed Canadian Bitcoin ETFs, BTCC and EBIT, track each other relatively closely, which highlights how these Bitcoin ETFs offer a more direct and efficient exposure to Bitcoin relative to a listed trust structure. In America, a Bitcoin ETF looks likely to be approved sometime in the future, with President Biden's pick for the SEC, Gary Gensler, being a crypto advocate and a blockchain enthusiast. Now, he hasn't been voted in to be the SEC chair yet, but it is likely that he will end up in that position. In Australia, ASIC haven't gone as far as Canada or America, but ASIC have announced that they are not opposed to a Bitcoin ETF. However, it must be noted that if majority of other developed countries continue to approve Bitcoin or Ethereum ETF applications, it would seem inevitable that ASIC would follow their path. Now passing over to Max to talk about cryptocurrency stocks.
Thanks, Mike. So another way to get exposure to cryptocurrencies, albeit indirectly, is to buy the companies that directly benefit from them. So an example of this would be the actual listed Bitcoin miners, of which there are a few. There are also hardware producing companies, and then a raft of sort of other indirect ancillary industries to Bitcoin, Ethereum, and other cryptocurrencies. But for now, we'll talk about the miners and hardware. So in terms of mining, you've got some famous names like Bitfarm, Rise Blockchain, and a few other major listed miners who at the moment say they're a blockchain company, but realistically derive 95% of their revenue from activities to do with mining Bitcoin. Ethereum miners are much smaller because you're not sort of participating in the same blockchain mechanism. And then mining hardware producers, you have people like AMD, who might also be known sort of a household level for producing graphics cards, and also Canon, which is listed in the NASDAQ, but is a Chinese manufacturer. And these are more around the chips and computers needed to have automated mining processes. For the miners, the headwind that we'll likely see in the future is their access to cheap energy, which will likely in the next couple of years, you'll have to take a stance on if you believe that green energy and clean energy can become sufficiently scalable and available to these guys, because that in the long run should be the most cost effective and ESG form of energy that they will tap into. For the hardware producers, the position I suppose you're taking is their ongoing increase in efficiency and also market leading. As the technology improves, the cost of production goes down, but at the same time, the cost of purchasing goes down. So as you get better technology produced by more people, then people will lose their share of the market. It may be simply easier to buy from a competitor for a marginally smaller processing power for a much lower cost of capital. So these are things that we need to be aware of. Another product that we don't have a slide on is managed funds. There are a few cropping up who will take a hold of the custodial nature of keeping the smart keys, ensuring the underlying holdings, and basically buying a basket of cryptocurrency. So they might be made up of 60% Bitcoin, 30% Ethereum, and 10% smaller altcoins. We're in the process of doing some pretty deep due diligence on that. We go through a process anyway with any managed fund that comes onto the platform in our menu for people to access through WealthMed. However, given the nature and the sort of fast-moving aspects of this asset class, we're taking that very seriously. So for the moment, just watch that space. There may be some in the future. We will let people know. One last point that we'd like to make on this is my point earlier about basically if you're not long, you're out, is how can we then regulate the risk to an overall portfolio? It's of our opinion that cryptocurrency should make up no more than 5%, so comfortably 2 to 5% of your portfolio. If you had 10% devoted to alternatives, maybe you'd split that in half and go 5% more traditional equity-based alternatives and 5% cryptocurrency. Within that crypto allocation though, you can diversify it further. So as Tim said, it's all about diversify. So you might have 50% of your portfolio tracking one of the ETFs that Mike mentioned, which are probably the safest direct exposure because you don't have to worry about the custodial responsibilities yourself. You might go 15% into buying the cryptocurrency stocks because you might think there's more significant upside, and some emerging mine or some emerging hardware producer might get an extra kick well and above the sort of the beta, if you will, of the cryptocurrency price. And you might go 35% managed fund because you want a broad-based basket of goods and have it slightly more insured, slightly more de-risked. So that's how we'd see a potential crypto portfolio forming. Of course, again, not a recommendation, and not everybody's risk profile will be the same, but we do encourage anything that you do, keep it a minimal allocation, and within that crypto itself, make sure that you diversify your source of exposure. And that sums up all we had to talk about. Happy to field any questions.
That's great. Thanks very much, guys. Look, I just wondered about having a second layer like the Lightning. Would that add additional risks? And if so, what would those risks be?
So yeah, good question, Carolyn. With adding a layer 2 protocol, it essentially will function very similarly to Bitcoin. All the characteristics and the security features will be relatively similar. On the Lightning network, you'll still have nodes like the miners, except it wouldn't be the same process where they would be competing so heavily for computational power and, processing all these complex algorithms, given on the Lightning network, the only real rewards for the miners would be the transaction fees. So in terms of the differences between, say, the main Bitcoin blockchain and layer 2, I think the only real differences would just be in slight differences in security features, albeit small differences, and also, yeah, just what I talked about with miners. These miners, there wouldn't be as many. They wouldn't have to go through the same processes, and they would just be compensated in transaction fees. One benefit to these Lightning networks through all this is that it's able to be a more efficient and cheaper method of transacting, because you only really have to have a small mining network to validate these transactions, and it's not a high cost activity for them because all they're really doing is just validating those transactions in that specific Lightning network.
I'm just also wondering, thank you for clearing that up. I'm just wondering, what's happening in the boardrooms of the banks? I mean, this is a significant disruptor, but a major advantage if you can sort of get this right. I mean, you're talking about needing massive resources to be able to mine, and you sort of wonder what's actually going on inside their boardrooms. Are they talking about this? Do they see this as a way for the future? Or, I'm just wondering, there must be something going on inside the big banks.
Yeah, I think definitely. And we've seen a lot of announcements coming out of the bigger banks. You've got BNY Mellon, the largest custodian bank in the world, announcing that they'll custody cryptocurrencies. You've got Morgan Stanley the other week announcing exposure to cryptocurrency funds for its wealthier clients. You've got as well Deutsche Bank have announced that they're going to custody cryptocurrencies. So there is definitely a wave of, I wouldn't say support, but a wave of adoption across institutional banks. We're not seeing the same sort of uptake in Australia, given we're a bit behind the curve. But in a lot of the American banks, it's sort of becoming a case of, if you don't start to do it now, you could end up behind the curve. And everyone's getting these head starts, and those banks which get left behind might be left with, not being able to provide these cryptocurrency services, or always just being behind the curve. But yeah, there is definitely an uptake across institutions, across banks, in providing cryptocurrency services and thinking of how they can leverage this rise in the price to further their business.
I think the major banks and financial institutions are looking at the blockchain technology more than the underlying currencies as a way to drive payment efficiencies. So I know the ASX, for example, is looking at distributed ledger technology to settle share trades. That's a classic case in point. As to people looking at, so how do we use this underlying blockchain capabilities. So it is absolutely coming down the pipe. It's being implemented in the real economy, for want of a better word. I think that the challenge with the cryptocurrency piece is none of them are regulated. So if you're a bank sitting there and you go to APRA, how do you measure the risk of running a prop desk or a trading business or a settlement function using a cryptocurrency? You actually can't. So I think the regulators need to catch up before any of the banks can get really serious about it in terms of actively physically engaging in that space.
Yeah, it's interesting. Look, we've got a question from Mick Simmons. Mick, I've just unmuted you if you'd like to ask your question.
Yeah, sure. Thanks, Carolyn. Hi, guys. I just added in the chat box there, just going back one topic, raising about the blockchain trilemma. I guess, the tech has to balance the security, the throughput, or processing power and decentralization. You can't have 100% of all three. And I guess as each platform favors one over the other, that's what sort of gives rise to these various markets on layer one. I guess, the first example is Bitcoin. Bitcoin is very secure, but it's slow. A competitor might be faster but less secure, and its users have to understand that that's the trade-off, and the resulting tech is what they benefit from.
Yeah, absolutely. That's the main message for the crypto conversation today is these are very different technologies. They might be built on a similar platform, but the way that they interact with the users and the validation is completely different. So there will be winners, there will be dramatic losers out of this, the next 5 to 10 years.
And much like you'd expect to see in the overall, let's take global equities, for example. In overall global equities, not only do you have, North America, Europe, Asia, within that you've got your subsectors of consumer cyclicals, materials, financials, etc. So I don't see why we'll end up any different for cryptocurrency in the case that we may have a selection of cryptos that attempt to act more like a store of value, more gold-like, like Bitcoin. And then we might have technologies like Ethereum, which are taken up more on an institutional level. It's unlikely to see, unless the Lightning Network is improved dramatically and we just focus on level one, an institutional bank to embrace Bitcoin to handle their transactions. But it's not unlikely, and we're seeing it now, even Credit Suisse have done massive work on building out their own digital ledger technology to handle payments more efficiently. By 2040, it's unlikely that we'll see any transfer agencies still in business because insto banks will have embraced that aspect of blockchain. So those might end up being different asset classes for investors going, do you want store of value? Do you want medium of exchange? Do you want, there may be other uses that we don't even know yet. So you're very right. The global landscape will be very much determined by the fact that not all of these can have the perfect unison between those three issues. But that will probably give rise to a lot more variation than we're expecting now.
Yeah. Oh, you're on mute, Carolyn.
I think you might have just passed it over to my question there, guys.
Yes. Thanks, David. Your question.
No worries. So the main security risk nowadays, as far as hacking towards cryptos and the security of cryptos, because a few years ago, there was big problems with the exchange networks being hacked and wallets themselves actually being hacked, but you haven't really heard much about that sort of an impact on the crypto network and things like that, and especially now that banks and big infrastructures and networks are picking it up, that their security has actually been heightened since the sort of inception days and when everyone was getting excited about it a few years ago.
Yeah. So I think on that point, we've really seen, I guess in the past we've seen a lot of instances of theft, security issues, but over the last few years we've really seen these sort of fears and issues evaporate, and that's largely been because back in the past, in 2015, 2016, 2017, cryptocurrency exchanges, cryptocurrencies themselves weren't really able to access traditional markets. being able to consult with businesses because they wouldn't be taken seriously, and because people didn't really understand much about cryptocurrencies, they would struggle to engage with the topic. And what we have seen is instances where this has led to issues. And now that cryptocurrencies are coming more into the mainstream, they're more able to access these services, get consultants in. There's a bigger industry of people to consult. And there's also a lot of community efforts in spotting bugs in code, pointing out security risks, and people do get rewarded for that. What I think we will continue to see is better services provided to the industry, given there is more money, which in turn will mean better security, and also more education to people, concerns about individual wallet hackings. If people are more aware of what the security risks are, they're going to be better suited to handle those risks. But yeah, good question.
Great. I don't have any more questions in the chat box. If anybody does have a question right now, now's the time to either raise your hand or pop a quick question in the chat box. Look, I would just like to reinforce what Tim said earlier. Nothing that's been provided today is intended for you to take it and go and invest. It's always important to seek independent and personal advice. We are going to have some options available for clients through a self-directed account on the Mason Stevens platform if clients have got a particular desire to add this to their portfolios. So that's something we'll be talking to clients about as we do our reviews. So I guess I would just really like to say thank you very much for your time, the work you've put in on the presentations, and we'll just watch this space. And look, there might be an opportunity if things move for us to do another webinar on this at some stage in the future. It's obviously very sort of interesting, dynamic space, and lots can change.
Well, thank you for the opportunity, Carolyn, and thank you everyone for attending today.
Thanks very much. Bye, guys.